Hey, what's up, everybody? It is Tuesday. What is it? April 19th. So we had a nice little rebound in the market today. I've been telling you that I'm bullish and you got to buy this correction. I've been giving you my reasons for that, and that has to do with strong fiscal, bank credit expansion, and market psychology is very, very negative. So we have those things going on. Plus, I don't think the inflation situation is enough right now to create a recession. I think what we are seeing is the market has discounted a slower rate of economic growth, and that's understandable because, as I've explained many times, inflation is a transfer of income to the foreign sector. The U.S. runs large trade deficits, and so higher import prices, that sort of thing. But to repeat once again, we are not in the 1970s where the U.S. is a major oil importer, and we have a situation where the central bank, the Fed, is quadrupling interest rates from like 4 to 20%, or quintupling interest rates from 4 to 20%. That's not going to happen. So I think we're going to avoid a recession. Labor market is strong. I mentioned that the average daily unemployment benefit flows 109 million. I mean, that's nothing. Today we saw housing starts very strong. Almost 1.8 million, 1.79 million. That is the highest since 2006. Building permits were up. Both of these data releases were much better than the forecast. I've been saying for a long time two things. Number one, home builder stocks are way, way undervalued, and particularly the way they've traded in the last few months with the fear of rising interest rates, or I should say rising interest rates. These stocks have gotten clobbered on the interest rate theme, but they do not reflect the fact that we have very low housing inventory here in the United States. And as good as that number is, 1.79 million units annually, that is still below what I consider to be, the threshold that would endanger the housing market in terms of a housing market correction or crash, if you want to call it that. I mean, every time we have seen a housing market, a major correction in the housing market, like you saw it in the 70s, you saw it in in the 1990s, or late 1980s to early 1990s. Of course, we saw it in 2007. I mean, you need to see housing starts above 2 million annually. And, if you go back to the GFC, the Great Financial Crash, the housing crash, in what was that, 2007, 2008, what happened was we saw housing starts drop down to an unprecedented low level of, I think it was like 375,000 units. And that was, let's say 13 years. It's taken 13 years just to get back up to let's call it 1.8 million units annually. And that's still below the threshold of 2 million units annually. And, a lot of times it has even gone above that, 2.2 million, 2.1 million units annually. We have a much big, look, in 1972, okay, when I think the U.S. population was 180 million people, we built 2.2 million homes in 1972. It is now 2022, okay? That's 50 years has gone by. We have a 320 or 330 million population here in the United States, and we're only building 1.8 million homes annually. I mean, there's not enough supply. So the builders have been very cautious. the stocks of the builders have been knocked down because of interest rate fears, but that does not reflect the need for more housing supply. And this could be a 10-year cycle in terms of these home builder stocks, where they're going to have to engage and they're going to have to, get on the ball and get active and start to deliver the housing supply that is in demand right now. I mean, everybody's talking about interest rates and the effect that's going to have on home prices. And yeah, we have seen somewhat of a pullback, a small pullback in home prices, not very significant, but it's not about the interest rate necessarily. It's about the lack of supply and the huge demand for housing of all, sorts. Just because we have a much larger population now and it continues to grow, and that need has to be filled. So I'm bullish on the housing stocks, and particularly I've gotten even more bullish now on this pullback, because the whole entire pullback has been driven by interest rate fears. Everybody's going crazy. Today the 10-year yield at 294. Yesterday I spoke about the fact that, we saw this already. We saw a higher level than this in November 2018. All right, when we had bond yields at 10-year yield at 325, 322, 325. So, and if you look at any kind, if you take this into perspective, and if you look at bond yields now compared to where they were, go back 20, 30 years. They're still historically very low. So we had strong housing start numbers today. We had a nice rebound in the stock market. I happen to think that the correction is over. I said that yesterday. I think we're going to have a major advance in the market. Netflix, after the close today, had some disappointing numbers in subscribers. It was the first time in 10 years that Netflix lost subscribers. The street was forecasting something like a 2.3 million addition or increase in new subscribers. They actually lost 200,000 subscribers. However, the company is more profitable than ever. So the growth story for Netflix is probably over. Look, let's face it, there's a lot of competition now. Disney, there's all kinds of streaming services now. So it's not like, Netflix was the only game in town for a long time. That is not the case anymore. But this is still a highly profitable company. But you have to trade this now like a mature company, as opposed to the growth stock that it was for so many years. And it was such a a rewarding play if you got in there early. Just saw the API inventory numbers. They came out a few minutes ago. A surprise build in crude, about almost 4.5 million barrel build. That's interesting because we are getting that weekly release from the SPR. Last week in the EIA, and we'll get that tomorrow, we saw a 9.4 million build. I'm sorry, did I say there was a build in crude? I meant to say there was a draw. The API number tonight, API inventories showed a 4.5 million draw. That's what I meant to say. Gasoline was up, distillate was down. The oil story to me is still bullish. Oil producers are still net long oil futures, and until they flip around, I'm playing oil from the long side. I just think that's, you got to align yourself with the trade, with the producers, and they've been long futures since last November, and they've been doing a little bit of light selling on the rallies, but they have not flipped anywhere near being short yet. So I think you got to maintain a bullish posture on oil until you see that happen, if it happens at all. I don't know. Japanese yen continues to go down. I think everybody's hopping on that trade right now. It's really the last couple of weeks, it has really accelerated to the downside. Two things working against the yen, and it's not monetary policy. That's the story you're going to hear you're going to hear that, oh, the yen is falling because the Bank of Japan is accommodative and you know, it's a monetary policy thing. It's not. I mean, negative interest rates, that's like a tax that removes yen from the system. That's actually a bullish thing, and I would say if that were not the case, the yen would be dropping a lot faster. The problem with the yen is Japan is running large trade deficit and a large budget deficit. So those two things are negative for the yen, and I would say that actually monetary policy by the Bank of Japan is an offsetting, is a mitigating factor. But if the Bank of Japan starts raising rates to, you know, quote unquote, defend the yen, then you're really going to see, you know, a very accelerated downward spiral in the yen, as if that's not already happening. It is. By the way, Japan's trade deficit is narrowing, so keep an eye on that. I mean, if that flips back into surplus, and a lot of that trade deficit is due to the run-up in oil, but if that flips back into surplus, then I would say you have two positive factors for the yen and one negative, which would still be the Japanese fiscal deficit. Anyway, that's it for today, folks. If you want to check out my report, MMT Trader, remember I'm the only one who has an applied approach to MMT. I take the understandings and concepts of MMT and I use them to invest and trade in the markets. Nobody else does that. There's a lot of academics out there and, you know, people writing papers and, you know, giving speeches, and that's great. But there's nobody out there who explains to you how to take that understanding and use it to profit in the financial markets. Have a great day. Bye.